A silver exchange-traded fund does not hold certainty. It holds structure. On the surface, a silver ETF appears simple. Investors purchase shares. The fund acquires silver. The share price tracks the metal's market value. Liquidity is abundant. Trading occurs instantly. Ownership feels immediate. But ownership in this context is not possession. It is a claim on a structure that depends on multiple layers of counterparties, custodians, authorized participants, and settlement mechanisms. As long as redemptions remain orderly and confidence in the chain remains intact, the structure functions seamlessly. Few examine what happens when redemption pressure changes character. In this chapter, we will examine the precise mechanics that govern silver ETFs during periods of stress. Why most investors misunderstand what they actually own, and why the phrase "won't pay" does not refer to refusal, but to limitation built into the system itself. The first contradiction is quiet. A silver ETF is marketed as exposure to physical silver. It is not marketed as access to physical silver. That distinction becomes relevant only when the run begins. Most large silver ETFs operate through a creation and redemption mechanism involving authorized participants. These participants, typically major financial institutions, can exchange baskets of shares for large blocks of physical metal and vice versa. Retail investors cannot. They can buy or sell shares on an exchange. They cannot present shares to the fund and demand delivery of silver bars. Under normal conditions, this limitation is irrelevant. The share price closely tracks the net asset value. Liquidity is deep. Arbitrage keeps discrepancies narrow. Trust stabilizes the spread between paper representation and physical asset. Yet that stability depends on willingness among authorized participants to facilitate arbitrage. If physical silver becomes scarce or delivery logistics strain, the mechanism adjusts. It does not collapse immediately. It adapts. Silver ETFs rely on custodians to hold bullion. That bullion may be stored in centralized vaults. Custodial agreements outline responsibilities, sub-custodians, and insurance provisions. The language is precise. But precision does not eliminate dependency. Dependency becomes visible only under pressure. When demand for physical metal rises sharply, ETF shares may trade at a premium to net asset value. Authorized participants are expected to deliver metal to create new shares and reduce that premium. But if sourcing metal becomes costly or uncertain, creation slows. Premiums widen. The structure remains intact. The representation diverges. This divergence has precedent. During periods of gold market stress in 2008 and again in 2020, premiums between physical bullion and paper instruments widened significantly. Retail demand surged. Mint supplies strained. Futures markets remained liquid. The two markets did not break. They separated. Separation signals structural tension. The assumption that ETFs guarantee seamless conversion into physical metal is rarely scrutinized during calm periods. Prospectuses disclose redemption restrictions. Most investors do not read them. They assume equivalence between ownership of shares and ownership of metal. Equivalence is conditional. In monetary history, such conditional equivalence often precedes transition. In the late 1960s, central banks participating in the London gold pool attempted to stabilize gold prices by coordinating sales. Paper commitments expanded relative to available reserves. When demand intensified, the pool disbanded quietly. Convertibility persisted for a few years longer. The underlying confidence did not. The run, when it begins, does not resemble panic immediately. It begins with preference. Investors shift marginally toward physical settlement. They question counterparty chains. They examine custodial structures more closely. Such questioning alone does not dismantle the ETF framework. It narrows flexibility. Silver occupies a dual role in the global economy. It is both industrial input and historical monetary asset. Industrial demand introduces cyclical volatility. Monetary demand introduces psychological weight. When currency confidence weakens gradually, precious metals often attract attention as perceived stores of value. That attention may manifest in ETF inflows. Inflows require additional metal acquisition. Acquisition depends on availability. Availability depends on inventories within vault systems and broader supply chains. If industrial demand and investment demand coincide, inventories tighten. Tight inventories do not imply disappearance. They imply prioritization. In such environments, the ETF creation mechanism may function, but at increasing cost. Higher costs influence arbitrage decisions. Arbitrage decisions influence share pricing. Pricing influences investor perception. Perception shapes behavior. Behavior feeds back into demand. This loop tightens slowly. Silver ETF structures are designed to withstand moderate volatility. They are not designed for simultaneous mass redemption into physical metal. The architecture assumes that most investors seek price exposure, not delivery. If that assumption changes broadly, stress concentrates at the interface between paper claims and physical supply. The run, in this context, is not depositors lining up outside banks. It is a shift in settlement preference. In banking history, similar shifts preceded monetary redefinition. Under the gold standard, depositors could convert paper notes into metal. As long as few exercised that option simultaneously, reserves sufficed. When confidence weakened and conversion demand increased, authorities suspended convertibility to preserve reserves. The system did not collapse immediately. It transformed. A silver ETF cannot suspend convertibility in the same political sense. It can, however, rely on contractual limitations. If authorized participants withdraw from the creation process due to sourcing difficulty or capital constraints, share liquidity remains, but physical linkage weakens. Investors may still trade shares. The shares may not correspond precisely to deliverable metal under stress. This is not deception. It is structural limitation. Structural limitations rarely matter until they do. The broader monetary context amplifies this discussion. Global debt levels remain elevated relative to output. Monetary policy cycles fluctuate between tightening and easing. Currency credibility depends on managing inflation without destabilizing credit markets. When debt saturates economies, confidence becomes more sensitive to perception shifts. If investors begin reallocating toward tangible assets, physical markets may experience strain. Strain in physical markets exposes leverage in paper markets. Paper leverage exists not only in ETFs but in futures, options, and derivatives layered atop underlying commodities. The ratio of paper claims to physical silver fluctuates widely. During normal liquidity, high ratios are sustainable because settlement remains predominantly financial. If settlement preference shifts, the ratio becomes visible. Visibility unsettles. Unsettling conditions prompt institutional response. Responses may include raising margin requirements, adjusting creation baskets, or encouraging cash settlements. These actions preserve order. They also confirm dependency on managed processes. Managed processes differ from organic equilibrium. Organic equilibrium relies on supply meeting demand naturally. Managed equilibrium relies on rule adjustments. Monetary systems tend toward management when imbalance grows. Management preserves continuity. Continuity masks transformation. The phrase "won't pay" suggests refusal. More accurately, it suggests that payment is defined contractually, not emotionally. An ETF pays in shares. It tracks price exposure. It does not promise physical redemption to all holders. This distinction is explicit in documentation. It becomes consequential when trust narrows. Trust narrows before collapse. In Argentina's repeated currency crises, bank deposits remained numerically intact while withdrawal access tightened. The Carlito did not erase balances, it limited conversion. Conversion rights define value perception. When conversion is constrained, perception shifts. Similarly, if ETF shares trade at persistent premiums or discounts relative to underlying metal due to stress, perception of equivalence weakens. Weakening perception encourages alternative strategies. Alternatives fragment liquidity. Fragmented liquidity reduces transparency. Reduced transparency increases volatility. Volatility invites regulatory oversight. Oversight reshapes markets incrementally. The pattern mirrors earlier monetary transitions. Under Bretton Woods, the US dollar was convertible into gold for foreign governments. As deficits widened and gold reserves declined, foreign conversion requests increased. Rather than deplete reserves fully, convertibility ended in 1971. The dollar remained dominant. Its foundation changed. The run had begun years earlier in marginal conversions. Silver ETFs exist within a fiat framework, yet they evoke convertibility logic. Investors assume that exposure equals security. Security equals accessibility. Accessibility equals convertibility. Each step is conditional. Conditional systems endure as long as conditions remain stable. When conditions shift, Endurance depends on adaptation. Adaptation may involve new custodial arrangements, enhanced disclosure, or regulatory refinement. It may also involve divergence between physical and financial markets. Divergence need not be catastrophic. It can persist quietly. Quiet persistence alters expectations. Expectations influence allocation decisions. Allocation decisions affect funding costs across markets. Funding costs influence currency strength. Currency strength underpins reserve status. The interconnections are indirect but cumulative. A silver ETF not paying in physical metal during a run does not signal immediate systemic failure. It signals boundary. Boundaries define structural limits. Limits narrow options. Narrowed options accelerate adaptation. Adaptation redefines markets. Markets that once promised seamless convertibility become markets of exposure only. Exposure differs from possession. Possession is tangible. Exposure is representational. Monetary history suggests that representational systems expand during growth phases. They contract or redefine during stress. Contraction may not mean disappearance. It may mean segmentation. Physical markets operate at one premium. Paper markets operate at another. Segmentation fragments trust. Fragmented trust complicates coordination. Coordination sustains modern financial systems. If coordination weakens, volatility increases. Volatility invites intervention. Intervention stabilizes temporarily. Temporary measures accumulate. Accumulation reshapes architecture. By the time observers declare that an ETF failed to pay, the deeper transition may already be underway. Not a collapse. A shift in how ownership is defined. Ownership of shares remains intact. Ownership of metal may not be implied. That difference, often dismissed during stability, becomes central during stress. The run, when it starts, is rarely visible in a single day. It appears in spreads widening slightly, in creation units slowing modestly, in custodial reports scrutinized more closely, in language shifting from assurance to qualification. Qualification signals caution. Caution spreads quietly. History records these patterns in various forms. The suspension of specie payments in the 19th century. The closure of the gold window in the 20th. Each episode involved tension between paper claims and physical reserves. Each concluded not with silence, but with redefinition. Silver ETFs are products of a mature financial era. They reflect confidence in abstraction. Abstraction scales efficiently. Efficiency encourages leverage. Leverage embeds fragility. Fragility reveals itself gradually. If the run begins, it may not empty vaults immediately. It may simply test the conversion boundary. Testing boundaries clarifies structure. Clarified structure narrows illusions. Illusions dissolve quietly. What remains is contract. Contract defines obligation precisely. Obligation does not always align with expectation. Expectation shapes trust. Trust sustains value. When trust shifts, systems adjust. Silver has endured as a store of value across centuries because it exists physically. Financial representations of silver endure as long as trust in structure persists. When that trust is questioned, the distinction between representation and possession emerges starkly. Emergence does not guarantee collapse. It guarantees awareness. Awareness spreads gradually. By the time widespread recognition occurs, adaptation is already underway. Markets evolve, monetary systems recalibrate, and what once felt interchangeable becomes differentiated. That differentiation, not the initial stress, marks transition. History suggests that transitions unfold slowly. They rarely declare themselves complete. They become evident only in retrospect. When future observers examine this period, they may not recall a singular moment when a silver ETF failed to pay. They may instead note how conversion expectations shifted quietly, how paper exposure diverged from physical access, how trust in representation narrowed incrementally, and how, by the time the run was recognized, the architecture had already changed. Money evolves through such subtle redefinitions. Trust migrates gradually, and systems adapt before they break. That pattern remains consistent across centuries of monetary history. It is seldom dramatic. It is rarely announced. It is understood fully only after the shift has settled into permanence.